you're thinking about selling your home here in Silicon Valley, one of the biggest questions I get is, what are the tax implications? Let's break it down so you know exactly what to expect and how to maximize your profit. My first caveat, I am not an accountant, so be sure to verify all of this with a tax professional. Number one, capital gains tax. So we're gonna go basics. When you sell your home for more than you paid, the profit is called a capital gain. In California, you're gonna face both federal and state taxes on that gain unless you qualify for an exclusion. Federal capital gains tax ranges from 0 to 20%, depending on your income and how long you've owned the home. California treats capital gains as regular income, with rates from 1% up to 13.3%, some of the highest in the country. Number two, the $250,000 versus $500,000 exclusion. This is your biggest tax break. Here's the good news. If you've lived in your home as your primary residence for at least 2 of the last 5 years, you can exclude up to $250,000 of profit if you're single and $500K if you're married and filing jointly. To qualify, you must own the home for at least 2 of the last 5 years, use it as your primary residence for at least 2 of those years, not have claimed this exclusion on any other home in the past 2 years. And if you meet these requirements, that chunk of profit is tax-free. Anything above that exclusion is taxable. Why this matters in Silicon Valley. Silicon Valley home prices have soared. The median seller gain here often exceeds $500,000 exclusion, meaning that many sellers are going to face taxes on at least a portion of their profit. For example, the median gain in some parts of Silicon Valley is now over $575,000. So how to minimize your taxable gain? Don't leave money on the table. Here is how you can reduce your taxable capital gain. Keep records of all major home improvements, that new roof, kitchen remodel, landscaping. These costs add to your home's cost basis, reducing your gain. Include eligible closing costs from when you bought the home. Calculate your gain equals sale price minus the purchase price plus improvements plus closing costs. If you're over the exclusion limit, only the excess is taxed. Next is reporting and paying taxes. If your gain exceeds the exclusion, you'll need to report it on your federal and state tax returns. Use Form IRS 1040 Schedule D and California Schedule D 540 for this purpose. Next is special situations. If you don't meet all the requirements for exclusion, you might still qualify for a partial exclusion due to job relocation, health issues, or unforeseen circumstances. So some final thoughts. Selling a home in Silicon Valley can be incredibly profitable, but the tax implications are real, especially as home values continue to rise and exclusion amounts remain unchanged. Careful planning and the right documentation, you can keep more of your hard-earned equity. If you have questions about your specific situation, reach out. I'm Shannon Ellison here to educate and navigate, not speculate and fabricate. Let's make your next move a smart one.